in 25 years because of inflation. Joining me right now is Slatestone Wealth Chief Market Strategist Kenny Polcari and Thru the Cycle President John Lonski. Gentlemen, great to see you both. Thank you so much for being here. Kicking it off with you, Kenny, your reaction to the jobs numbers and what it means for higher interest rates.
So I'm not necessarily surprised by the number. I think it came in right in. I thought it was going to come in right in line, and in fact it did. Unemployment, though, was interesting. That went down to 3.5%. But it doesn't change the narrative at all with what the Fed is going to do in November. Rates are still going to go up 75 basis points. I think that's very clear now. I think that whole idea, earlier in the week that the Fed was going to pivot was completely way overdone. And we're going to see the market, I think, struggle as we move into earnings season.
Yeah, John, a lot of people talking about the fact that we're still generating hundreds of thousands of jobs every month, but the expectation is that slows down going into year end and next year to about 100,000 a month. But what's your take on the numbers and also the fact that the participation rate went down to 62.3%?
Yeah, I'm shocked at that decline by the participation rate. You would think with faster price inflation, more people would be forced to go out there and find a job to try to compensate for the loss of purchasing power. Talking about the loss of purchasing power, we can take a look at the wage rose by only 0.3% monthly in the month of September. Year over year, that fell to 5%. My goodness, that's a huge gap between 5% wage growth and CPI inflation that's running at 8.3%. That's a reduction in the purchasing power of the wage. That bodes poorly for consumer spending going ahead. One thing I'd like to add, that Fed funds rate is expected now to finish the year at 4.4%. That's going to be up by 4.25 percentage points since the start of 2022. We have not had so great of a year-to-year increase by Fed funds, the benchmark for variable rate loans, since the end of 1981. And of course, that coincided with one of the worst recessions in the history of the United States.
And is that what you're expecting in 2023?
I hope the recession won't be won't be that severe, but you have to expect a decline by the overall economy, a rise in unemployment, maybe the unemployment rate now at 3.5, headed up towards 6%. And of course, with this, there's going to be a great deal of pain, and this could have important implications when we go into 2024's presidential election year.
Yeah, that's a great point. Kenny, I want to go back to something John just mentioned, and that is this pay cut. Americans are suffering the biggest pay cut in decades because of inflation. This is a study by 3 economists at the Federal Reserve Bank of Dallas, and they found that real wages have fallen for most workers over the last year. Even though nominal wages are rising, prices are rising even faster, and when you see inflation, it's cutting into whatever wage gain you had. So this is the biggest pay cut in 25 years.
Well, John just made that point, right? Inflation is running at 8.3%, but wages grow only 5%. So workers are actually losing every single month. So that's not a surprise. Shouldn't be a surprise to anybody. Everybody's been feeling it, and you can hear that conversation everywhere you go, which is why we're still seeing upward pressure on wages, but they're not catching up with the pace of inflation, and that's going to continue to be a problem for consumers if inflation doesn't come down at all, they're going to continue to feel that strain on the pocketbook as we move through the end of 22 and into 2023, which I think is going to be another difficult year.
Yeah, it's pretty unbelievable what we're seeing out there with regard to inflation. A dozen eggs up 40%, coffee up 17%. I mean, these are the things that we buy every day. It's not 8%. It's actually double digit. Let's look ahead, John, because there is some expectation that inflation is peaking. I don't see it. Do you? We got the Consumer Price Index out next week, and then we'll be followed up by the Producer Price Index. What are you expecting from the CPI out on Thursday?
Unfortunately, Maria, you are going to be proven correct. I doubt if inflation has peaked, especially since we now have this latest return of rising energy price inflation, rising gasoline price inflation. You know, come Thursday, we're going to get the September CPI. The headline number maybe eases from 8.3 to 8.1%, but the bad news is going to be core CPI. That excludes food and energy prices. It picks up speed. It rises from basically it's around 6.2% to 6.4%.
And your thoughts as far as the market reaction, Kenny?
And that doesn't even include the rise we've seen in oil over the last week, which won't be reflected until the next month. But my thoughts are that it's going to continue to put pressure on the broader market, just because it's clear now that the Fed isn't moving, and they're going to may remain aggressive if we don't see inflation starting to respond at all. And it doesn't really feel like we are. And my fear always was that we were going to see this slight downtick in inflation, and then it was going to rear its ugly head again, which I think it potentially could do in November.
Yeah. All right, we will leave it there. Kenny Polcari, John Lonski, always a pleasure. Thank you, gentlemen.
Thank you.